way we're personally protecting the investments at Aligned is on key items like repairs and maintenance, X materials, right? If we need to buy cabinets, sinks, if we're doing refurnishings, I think number one is we're taking a look at what are all the things we're planning to value add on this property? How much do they cost today, right? Because remember, if you're buying 200 units and you're replacing washers, cabinets, and today they cost $4,000, again, what if tariffs make it $5,000? So what we're doing is we're adding a 20% buffer to our CapEx internally. And the reason that's a safe play for us is because, number one, we're protecting the downside on that expense risk. But if that doesn't happen, right, if we don't fall into a 20% tariff and those expenses don't happen, then whatever we projected on our returns and to our investors, then we're able to outperform that. So at least that's our model right now, is look at key line items on the pro forma that are most subject, right, to tariffs in terms of expenses, and put a buffer. Don't just assume this is going to grow by 3% a year. Put repairs and maintenance at 6% a year for maybe year 2 and year 3. Your CapEx, if it's everything is $5,000 right now, add another 20% to it. If you're looking at deals with sponsors right now, I think a good question that you can ask is, what are you forecasting in expense growth? Year 1, year 2, year 3, year 4, year 5. And if somebody tells you, oh, we're forecasting 3%, which is the industry norm when you underwrite, the follow-up question should be is, what are your thoughts on tariffs, right? What if some of these materials are going to end up costing more? Do you have any contingency for that, any buffer for that? Because if you're forecasting 3% and they're going to be higher, that's going to affect your returns as an investor. And that's going to be a really good gut check for you to see how conservative your sponsor is and how much they're staying on top of things. I think those are really the two big risks. And now I want to talk about how to protect your investment. Okay. So there's a couple of other things that you really want to focus on right now in today's economy. I think the first, and this is a really big one for us, is you want to target low rent to income neighborhoods. Right now, rent to income essentially stands for what is the average rent in the market versus people's median income. Okay. If you have a 30% rent to income, that means somebody in that market, people are giving away 30% of their income for their housing expense. So anything below 30%, I would say right now is good. Anything below 25% is great, right? Anything below 20%, we love those deals. Because think about it. If people aren't giving away a huge chunk of their income towards rent, that's going to allow us as operators to have much more room to increase rents during a period of potential inflation, right? Because if people are too squeezed by their expenses, they're not going to be able to afford these type of rent bumps. And like I said before, as an apartment operator, if you can't increase rents and you're forecasting that in your business model, that's going to be a big problem. So right now, what we're doing internally is we're staying away from anything that's over 35% rent to income. If it's in the 30 to 35% range, could still be acceptable, right? You got to look at the deal holistically. There's a lot of other aspects to it. But in terms of tariffs, inflation, and how we're protecting that is what we're focusing on, good rent to income numbers. But another thing that you want to look at is the median income in the area, okay? So median income, anything below 70,000, if you think about it, the people that are going to get affected the most by inflation are people that are making below $60,000, $70,000 a year. People that are making 30, 40, 50 grand, they really feel the price of their groceries going up by 10%, right? People making six figures, sure, they still feel it, but they don't feel that same tight grip. So there's really two things. It's not just rent to income, it's also the median income in the submarket. Because if the median income is high and the rent to income is low, that shows us that market is very well positioned to handle a little bit of inflationary pressure, where we could still execute our business model, we could still increase rents and so on. So I would say that's probably probably the biggest thing we're looking at right now during this time. I think the other one would be is focus on submarkets with low new supply and high absorption, right? So some markets, they don't have any new supply coming and all the inventory is eating up because we have a huge housing shortage in the US. The last readings, some forecasts show that we're about 4 million homes short. Some show that we're 6 million. The bottom line is it's a lot. We're very far behind. So if there are particular markets that have no new supply coming and all their units already absorbed, that's going to make it easier for us as landlords to be able to increase rents, which is going to increase revenue, which is going to increase property value. So those are things that you want to be asking your sponsors, okay? So just to recap, just quickly ask them, what is the rent to income? And your sponsors should know this. If they're in the business of acquiring assets and they don't know what the rent to income is, that would be an issue. You should ask them, how much new inventory is coming on this market? Can you tell me the new inventory versus the amount that's being absorbed? And if those answers are good, you should feel much more comfortable about the deal. So I think the other thing we're trying to avoid right now is very heavy value add projects, right? So value add is when you're coming into an older property, maybe it was built in the 80s, 70s, sometimes even 60s, right? Where it's just outdated, right? And you're going to do a new kitchen, you're going to do new tiles, you're going to do new bathrooms. So whenever you have really big value add projects, you have a lot of material expenses. So anything that's $10,000 per door in value add, we're skipping right away. We don't want to see anything more than $2,000, $3,000 a unit. The reason being is, again, in this particular climate, if you're doing these big renovations on units and tariffs happen, and now all those kitchen cabinets, all those tiles, whatever material you're buying is now 10, 20% more, and you didn't forecast that in your pro forma, that's going to be a problem because you're not going to be able to deliver those returns. So I think a question that I would be asking if I was a passive investor is, how much are you putting into each unit? And I would be asking, how much does that cost today? So if it's $3,000 today, then I would say, did you put a buffer on that in case we get hit with a 20 or 30% tariff? Us at Aligned, we're putting a 20% buffer, right? So just in case the tariffs do stick, we already planned for it. And guess what? If they don't stick and we get lower pricing, that's fantastic. Then we're going to be able to over deliver what we promised, and we'd much rather do that because that's how you create raving fans in your business, when you under promise and you over deliver. So I would say that's another question that I would be asking sponsors. The other big thing that I mentioned, I'll just reiterate, make sure you're going into projects that are longer hold periods, right? 5 to 7 years to ride out this volatility. Nobody's really expecting this to stick around for too long. Sure, it's making a lot of headlines, but if you think about it, there are midterm elections coming up. Politicians, they can't win midterm elections with consumer prices increasing like that. Also, Trump started the whole tariff thing. He has a term, right? So after his term is ended, it's hard to imagine these tariffs would continue. And again, even if they do, they're a one-time bump. So it's just volatility now. And as long as you have this fixed rate debt to protect yourself against that, then you don't have to pay attention to the noise on a daily basis. For me, I don't want to wake up and look at what's going on with tariffs every single day. I know I have long-term financing. I know we have a huge supply shortage. I know eventually rates are going to go down. I know eventually these properties are going to go up in value tremendously. So fixed rate financing, I would say, is the way to go. And I think the other big thing that not a lot of people are talking about is not only do we have this huge shortage of housing right now in the country, but in the past 2, 3 years, new development, new projects have almost come to a halt. Look, I speak with some of the biggest developers in the country, right? I ask them, hey, what's going on? What are you guys building? They're like, we're not building anything because it's very hard for them to build right now. When the cost of financing is this expensive and they have all this uncertainty on how much their supplies are going to cost, it's hard to take those risks. The projects just don't pencil. So when all this new development stops and we already have this huge shortage in housing, there's going to be a trickle effect, right? In the next 2, 3 years, that shortage is only going to increase. Now, again, basic supply and demand, right? If you have even less apartments and the population is still growing, right? People are still moving into the country. People are being born. People are turning 18 and getting their own place. They need a place to live. Now, if supply is less, that's going to give us the ability as landlords in the years to come, 3, 4 years down the line, to really increase rent growth and potentially outperform expectations on revenue. So a lot of the industry sees a lot of opportunity in the next 3, 4 years to come. You just need to have kind of the patience and be able to see that long-term play. So I would say these are the big things that I would be doing right now in order to protect investment. And you see in the next slide, when we talk about supply, demand, and opportunity, right? We spoke about projects being delayed, right? People aren't building because builders are scared of inflation, right? The U.S. housing shortage, spoke about that, right? That's huge. So less new supply is going to equal more rent growth. But I think the biggest thing now, and a lot of folks believe that this is one of the greatest investing opportunities since 2008, is you're seeing huge, massive discounts on institutional grade assets. And the reason for these discounts is because people's rate went adjustable. Their rate is no longer fixed. Their rate went from 3, 4% when they locked it into 7, 8, 9%, and they can't make their debt payment. And now the bank is either going to take this take this building, or they need to sell it, or they need to call their investors and ask for more money. So there's a lot of folks right now that got their back against the wall. I could tell you now, there's nobody selling commercial real estate unless they have a big reason as to why they have to. Everybody knows that eventually when rates go down, property values are going to go up. Selling right now, people are selling at a 20, 30% discount. And I think that's the biggest thing that we're trying to capitalize on in today's market. And the way we're actually doing that, we're actually starting a 25 million distressed asset fund. So the goal with this $25 million fund is to acquire $90 million in real estate. I'm personally putting, out of that 25 million, I'm personally putting $5 million of my own capital alongside investors. So what we're targeting here is, again, these distressed owners that kind of have to sell, and assets where we could add value as soon as we buy them. We're targeting a 14 to 16% IRR. That's about a 16 to 20% annualized return. We're targeting a 2x equity multiple. So we're looking to double investor capital in the hold period. The hold period is going to be a 4 to 6 year hold. And we're also offering a 9% pref on this fund. So if anybody's interested in having a chat about this, we have a link here. You could feel free to scan that to book a call, or you could email us at invest@investav.com. So a little bit, I want to just jump into this next slide here and just take a look at what some of these institutional leaders are saying. So John Gray from Blackstone, right? All the factors are in place for a strong deal-making environment in 2025. Real estate continues on a path to recovery. And by the way, with Blackstone, their actions speak louder than words. Blackstone deployed $25.3 billion into real estate in 2024. That's a $9 billion increase from 2023. That just shows how bullish they are on what's going on in the market, right? They're putting their money where their mouth is. CBRE investment management, right? Valuations in core regions are down 16 to 25%. This creates a tactical entry point. And that's just a very professional way of saying it's a good time to buy. JLL, opportunities will be plentiful in the coming year. Supply shortages will worsen for in-demand assets. As we said, construction slowed down. Supply is only going to get worse. That's going to drive evaluations up. So this is what some of the biggest institutional funds in the country that focus on real estate are saying. We're seeing it ourselves. And I want to just actually show everybody, we focus on the Dallas and Houston market. So over here, if you look at the slide, this is the forecasted cap rate for Dallas. And you could see right now, depending on the asset class, right, it's about 5.5 to maybe a 5.7 on the cap rate. But you could see the forecast in Dallas, even in the whole country's in yellow here. Everybody's projecting cap rates to go down. This is where we see the big opportunity, because cap rates, they play such a big role in your property evaluation, right? Just to give everybody an example, if you have a 5 cap and the property makes $1 million in revenue, it's about a $20 million property. If that becomes a 4 cap, it's a $25 million property, right? A difference of 100 basis points on $1 million in revenue increases the value by $5 million, right? So you could see right here, even with all this interest rate uncertainty, CoStar, which is one of the huge data providers in our industry, is forecasting about a 50 basis point decrease in the Dallas market through the next 5 years. The reason we see that as a big opportunity is because when we're underwriting deals right now, we're not assuming any drop in our cap rate. Like when I'm looking at deals and my underwriting team brings a deal and presents it to me as the investment committee, if we're buying it at 6 cap today, I'm still even putting a little bit of a buffer. I'm still saying that we're going to exit at 6.25. Now, if by chance we exit at 5.5, that 2x multiple that we were going to get turns into close to a 3x multiple. Those returns go from 16 to potentially 28, 30%. So that's where we see the opportunity, because the market is underwriting conservatively right now. People learned their lesson from COVID, but the predictions are cap rates will go down and these property valuations will increase. And over here, I have a quick chart for Houston as well. So you see Houston is also forecasted to go down about 50 basis points in the next 5 years on cap rate compression. So these are obviously the two markets we focus on. We only play in where we have local presence, where we have feet on the street. So we're really excited to see this, especially when we're underwriting this conservatively. And yeah, just wanted to give a little bit of that. So I think just to jump in, right, in conclusion, to wrap it up, tariffs and inflation risk, it's about understanding it. It's not about fearing it. Yes, tariffs could cause a short-term bump in inflation, but it's not like COVID. There's no runaway risk here. It's not going to be compounding. It'll be a one-time adjustment. And if you underwrite for that and you plan for it, you could end up getting actually a lot of upside because you planned for it and it didn't happen. And if it did happen, that's great. You still had it as a buffer. Interest rates, look, they're likely at their peak. The Fed is signaling rate cuts. Inflation has been cooling, right? The Fed did an incredible job. By the way, if you think about what happened when inflation was at 9%, I remember watching every Fed meeting 3 years ago. I remember watching the news. Nobody believed that the Fed was going to be able to get inflation under control and for us not to go into a recession. It was called a soft landing. We were able to do that. Like, I take my hat off to Jerome Powell. They did an amazing job, right? Because usually when you increase interest rates that fast, you hurt the economy. You could go into a recession. Everybody was predicting that. but they were able to get it down. Inflation is under control. We might have a little bump because of tariffs, but considering the job they've done, we don't see it as an ongoing problem. Expense growth, we spoke about that, right? If you plan that your expenses are going to be higher in some places, you don't have to lose too much sleep over it. It might not happen. Then you get upside. And then I think the bigger picture is there's a lot of opportunity because people made a lot of poor, I would say, aggressive decisions in 21 and 22. There's a big housing shortage, and that's only going to get worse with construction not starting. So I would say this isn't really a time for panic. It's a time for strategy. If you understand the dynamics and you plan accordingly, this market offers an incredible opportunity. Personally, obviously, I'm a little biased, but again, I'm all in this with my own capital, right? I'm pretty much pot committed as anybody could be. I'm planning on deploying within the next 2 years a total of $23 million into this asset class of personal capital that I made in previous industries. But I have a lot of friends, a lot of colleagues, a lot of industry leaders that kind of see the same market conditions. We're pretty excited about what's to come and happy to be able to share this information with everybody on the call. We'll go ahead here and start wrapping up. Let's jump into Q&A. So Sam, do we have some questions that came in? Sammy there?
Yes, I'm here. I was on mute. Yep, we have a couple questions that came through. So first question is, if interest rates continue to go up, will it be a better time to buy then?
Sure, it could be, right? But market timing is at least the way we look at it. If the opportunity, if right now, if you could buy a property that is cash flowing, that shows good returns, we believe in taking advantage of it because market timing is, there's so many factors, right, that come into play. A lot of people, they wait to market time and they miss out on opportunities as they are today. Sure, it could be a better opportunity, but I would say I probably see people missing opportunities more than benefiting when they play that model.
Okay. Our second question here is, what asset classes is the fund targeting?
Yeah, so it's really, the asset classes is mainly products that kind of fit a lot of these categories that we spoke about. We like Class A, we like Class B, we also like Class C as well, depending on the amount of deferred maintenance it has, the amount of risk it has, the amount of returns it has. So all those classes are great opportunities. It's really about some of those other dynamics, like what is the median income? What is the rent to income ratio? I think a lot of what we spoke about right now, that's a lot of our buy box. So the assets that we're looking at, they have to fit into that buy box in order for us to capitalize on it in the funnel.
All right. That looks like that wraps up our questions.
Okay, great. So yeah, the next webinar we'll have is going to be around taxes and depreciation. So we're going to be speaking about essentially how people investing passively can lower their tax bill and some of kind of these advanced strategies that people in real estate are using. So we'll be sending out invites, and thank you for joining and wishing everybody a great night.